Hi, everybody. I'm Josh Bisman, an associate professor of finance here at Loyola Marymount University. I'm here, as always, with my colleague David Offenberg, and uh, I've been thinking a lot about pizza, David. So when we get pizza for dinner, which we had this past week, my 5-year-old always wants more pizza. She always wants more slices, and so what we do to sort of trick her is we take one slice of pizza, we cut it in half, and then we'll give her one slice, and then she says she wants more, and we say, oh well, here's another slice of pizza, so now you've had two slices of pizza. And so far we've been able to fool her, and I'm wondering, does this, is this
This
related to
happens in
finance at all?
finance. It happens in finance all the time,
Well,
right? Google
yeah.
did it this week. Alphabet did it this week with their stock split.
Right. So yeah, so what actually happened with Alphabet?
So they announced a 20 for 1 stock split. 20 for 1 means that they're going from, having one big share. Your one big share gets split 20 ways into 20 pieces. They did this in 2015. They did it 2 for 1. So your one big share got split into 2. And when they did it in 2015, they split the voting rights too. So you ended up with one share that had a vote and one share that didn't. This time, that's not happening. All 20 of these shares, they all get votes. And what that means for the investor is that right now the stock's trading at about 28.50 per share. So they're going from one share at 28.50 to 20 shares, each at 142.50. And then the investor can decide how many of these 20 shares they want to keep. They can keep them all, they can keep one, they can keep 10. It's totally their choice.
That's interesting. Does that mean do I have more? Is it like my daughter thinks she has more pizza? Do I now have more Google?
You don't get more Google because everybody's getting a 20 for 1 split. So proportionally, everybody owns the same amount of Google as they did before. But they're doing this for a couple reasons, as far as I can tell. One is that when they get the price down this low, it's more accessible to retail traders, babies in high chairs, people like you and me, and our students.
Right.
So when you have more retail traders, the evidence suggests that more people buy the stock. There's more demand for the stock. We saw huge bumps in recent years with Apple and Tesla doing similar stock splits. They saw huge bumps in retail trading. And so that's good for demand for the stock, and in theory might raise the price, maybe not. The second reason that they're doing this is because they maybe want to be included in the Dow Jones Industrial Average. The Dow Jones Industrial Average is a group of 30 stocks handpicked by the Dow Committee that are supposed to be representative of the economy as a whole. But the Dow is unbelievably a price-weighted index, which means that it gives the most weight to United Healthcare. Because of the 30 stocks in the Dow right now, United Healthcare has the highest price. Which makes no sense. It makes no sense because if you look down here at Apple is 5 times bigger than United Healthcare. The average investor owns 5 times more Apple than United Healthcare. Their wealth is 5 times more dictated by Apple than United Healthcare. But in the Dow says United Healthcare is more than twice as powerful as Apple. It makes no sense. But that aside, if Google were in here at 28.50, half of the performance of the Dow would be Google. And that's not the point. The point of the Dow is to be a representative basket of stocks. So Google had to get their price way down to get included here. And there's mutual funds that need to trade the Dow. There's investors who track the Dow. So there's real advantages to being in the Dow.
Got it.
And do you think this is actually going to help their stock price?
Well, in theory, it shouldn't matter, right? So you're right. So what you've already explained, but historically, there has been some evidence that shows when these companies announce these stock splits, they get about a 1.5% abnormal return. Now for Google, it actually did. We did see a big return. It was actually closer to 10-11% announcement return. Excuse me, not Google, Alphabet, but Alphabet also announced earnings that day. So there's likely some impact that they had they had strong earnings and strong forward-looking guidance. So but definitely some of this return is likely due to this to the stock split. And this drives people like academics like you and I just crazy, because we know, I know that my daughter's not getting any more pizza than one slice.
That's right.
But it seems to still have an effect. But it does remind me of, Warren Buffett. And brought out my Warren Buffett,
There
fat
he
head
is.
for today. So there he is looking over us. And, he's famous with Berkshire Hathaway to never split their shares. And in fact, he had the shares of their Class A shares have never been split. They've never split their shares because he understands that there's no reason to do so, and he actually likes a high price. He thinks it sort of keeps certain investors out of their stock. But what happened, interestingly enough, in 1996, Warren Buffett actually they created this Class B shares, and the reason they created the Class B shares was due to these trusts forming. And what the trusts were going to do, essentially a mutual fund that was only going to buy Berkshire Hathaway shares and then basically sell you a piece of it. So you and I can't afford $2,000 per share, but we can afford $20 per share. And Warren Buffett didn't like this. He felt that they were going to charge fees. So in his annual letter to shareholders in 1996, he sort of explained why they did this. However, Berkshire Hathaway in 2009 did split the B shares when they were acquiring Burlington Northern. And the reason for this was really for tax purposes of the shareholders of Burlington Northern, because they were going to pay them in Class B shares. And there's some tax implications to doing so. So the split allowed that avoidance. So there are some potential explanations for this and reasons for it. It's really just one of those kind of weird things. But I have a question now, Dave. I mean, I'm thinking I should just go buy a bunch of shares of Alphabet, right? Because they're going to have, this is great for them, isn't it?
Well, I think your graph showed it. The effect is already priced in. People have already bought the shares expecting the split to happen. And I don't think anybody at this point can still buy in and gain the benefits from the split. That's just my 2 cents. But, we're not offering investment advice.
Yeah.
Here.
Well, as usual, then I missed out.